Okay, everyone, I find there's two extreme thoughts that happen with emerging markets. On one end of the spectrum, you have some people who say emerging markets grow faster than developed markets in terms of GDP, and they're undervalued right now, and sooner or later they're really going to hammer developed markets, stock markets. You have the other extreme, which is, well, look, Apple, Amazon, and all those big companies listed on the S&P, MSCI World, and so on, most of them sell to the emerging markets, right? So they're getting sales in Africa, Asia, South America, and whatever. So you don't need any emerging market exposure. In general, what I would say is this: having 10% in an emerging market index might make sense in terms of this. It is true that over some pretty long periods of time, even 25, 30 years, an emerging market index can sometimes lose to, say, the US S&P as an example. However, they're more volatile, which means that they can be really quite extreme. Sometimes they can go up by 40%, sometimes down by 40%. That might sound extreme, but a lot of studies that have been done have shown that even during periods where emerging markets have underperformed, if you add, say, 10% of diversification and you just buy, hold, and be balanced, it can increase the returns, because essentially what happens is when they get too overvalued or too undervalued relative to the other markets, you're able just to adjust your portfolio. But I wouldn't have a huge allocation to emerging markets, because I do think that there's a lot of reasons why they carry more risks than something like the US market, or indeed a more diversified market like the MSCI World. Okay, everyone, have a good day.